Welcome back to Markets at Noon right here on ET Now. And taking a look at the markets, well, of course, we are consolidating on the index and benchmark indices front. Nifty up around 90 odd points, while Nifty Bank is just the opposite, down almost 113 odd points. But it's the metal counters that are shining bright, and some of the stocks within the oil and gas space like ONGC, HPCL, they are also bucking up the trend. Insurance counter is the another pack that is doing and holding up well. Stocks like HDFC Life as well as Max Financials, they have been doing well in trade right now. And some of the other result candidates like Siemens, they are also holding up to that shade of green. What's not doing well is actually RAC after the guidance and the recent guidance that has come out by the management. Tata Motors, like even a good set of numbers, the management commentary, but believe that the run-up was already through when it comes to Tata Motors, and a bit of a profit booking there. And some of the other candidates like Cipla, they are also down in trade right now. The breadth of the market looks quite cheerful, but the good part is that the India VIX is taking a sharp knock. A 5% cut is what we are seeing in this particular index, because of late we have already seen India VIX shooting up anywhere between 20 to 21 odd range, and now it's standing at 17 odd mark. So that's the construct of the market, but a lot many moving parts in the markets right now. But what should your strategy be like? Let's try and find an answer to that. We are being joined by Siddharth Vora, Head of Quant Investment Strategy and Fund Manager at PL Asset Management. Hi Siddharth, a very good afternoon. Good to see you back on the channel. Help us understand, how are you placing your bets in this market? Because it was just when we started, the FIIs making a comeback in the Indian markets, but then we have the geopolitical tensions coming back, the China deal being announced. Do you believe that the FIIs are here to stay, or there could be some way out?
I think I would see both of these events as a negative event in the near to medium term for India. So I think everything that sort of worked for us, whether it was falling crude, weakening DXY, FIIs coming in, China being out of the race for some time, and India being in pole position in terms of global flows and global growth, and India being the only sort of geopolitically safe, secured, large economy. All of these things are now unwinding in the other side, right? Crude is rising, dollar is strengthening again, US bond yields are rising, the US-China trade deal is not so good for India, at least sentimentally and from a flows perspective. And the recent geopolitical stress has also taken out some shine from India. I think valuation premiums could contract for India in the near to medium term. And given that we don't have much upside room in terms of valuation left, we could be in a very narrow range market. So it would be tough to find meaningful upside of 12, 15, 20% in Indian markets. There would be single digit upside in Indian markets from here on, given the way narratives have changed over the last, I would say, 10 days.
The fact that a single-digit return is something that one should expect, but within which particular basket should one look at? Because in the large caps, which are the safer havens, do you believe that one should place their bets there, or maybe the SMIDs are offering more good opportunities at this point in time?
Small cap allocation is significantly underweight. We barely have any small cap allocation. It would be under 10%. 50 to 55% is large cap, and the balance is mid cap. So I think our portfolio is currently biased towards large and mid cap. I think there's better valuation comfort, better resilience amidst all the chaos. And I think chaos is the new normal in Indian markets and global markets. The way things are panning out with pandemics, wars, trade wars, a lot of things are changing. So I think chaos is here to stay. So we have positioned our portfolio defensively in terms of size, but aggressively in terms of sectors. That's how we brought in the beta. We are positioned into high beta sectors like lenders, like capital market plays, like metals, some high beta domestic consumption plays, and some defense as well. That's the broad positioning of the portfolio. We also have our global exposures to IT and metals, to see the global rebound playing out in the markets. And we've been positioned in that since roughly 2.5 months. So hopefully that position should recover well like it is right now. And yeah, I think that's the broad positioning, large and mid, and balance between domestic and global plays, because you can't take either sides in a market like this where there's so much uncertainty.
Ankita also joining here. Good afternoon to you. So high quality lenders, capital market theme, IT and metals could see a re-rating. So that is where you're positioned at. One more thing that I want to bring to your attention, Siddharth, is the fact that, with this entire Trump and China saga playing out on the tariffs, now that the tariffs have eased up, is India likely to lose a certain relative advantage that we had over China? Will that start ebbing away as far as the foreign inflows are concerned?
If I look at Indian markets 7 days back, we were the only large market which was growing fast, had domestic macros, which had interest rates coming down, inflation under control, zero geopolitical stress, and our biggest large EM competitor, which was China, that had lost a major advantage. So from a relative perspective, India was in pole position and the strongest placed global market. Now, two of the advantages that were playing for us are actually going against us. And therefore, from a foreign capital flow, I think this is not such a great moment for India, at least in the near to medium term, till this is discounted either with a price correction or without time correction.
But
We've lost a pole positioning right now.
What's your advice? Where are you finding some signals of caution for the investors where they should actually look into their investments? The sectors are not expected to perform well, given the fact that one should stay cautious is the advice coming from you.
I would say stay cautious, stay invested, and just position the portfolio to the current market environment. We also have meaningful allocations to defense, like 5% of our portfolio is defense. Another 10% is absolutely defensive financials within the insurance space or the regulator space. So we have defensive positioning within aggressive sectors also. And other than that, we have Bharti Airtel as well in our portfolio, continues to be a large and long holding for us. And I think it's done very well in all the chaos in the market because it is neither affected by geopolitical stress nor is it affected by global tariffs. So this is just an example, not a recommendation. This is just to say that in every market condition, you will find some themes and some ideas which will position well given the market circumstances. For now, a name like Bharti Airtel or HDFC Life is very well positioned despite all the global and local chaos. So we have to find those ideas and be aware of signals turning against us, like crude, like dollar, potentially foreign inflows as well. We need to be aware, we need to be vigilant, and we need to keep realigning the portfolio to deal with the changing market conditions.
Right. So that also you mentioned that you're well positioned in domestic consumption. Now, which part of consumption do you see value in, the discretionary end of it? Because if you look at the discretionary end of it, whether it is the travel tourism sector, the airlines, these themes have already played out quite a bit right now, right?
So we've exited, fortunately, our entire travel and tourism exposure roughly 25 days back. And I think we're quite happy with that exit, because I think valuations leave, again, little room for the upside. And now, of course, there's a new trigger of uncertainty, right? We'll never know when it's over. We might be on the edge for some more time. How much ever, a ceasefire is announced. We've seen ceasefires being breached, whether it's Israel or whether it's Russia, Ukraine. Ceasefires do get breached time and again. So I think currently it's probably a better space to avoid rather than hold, in my opinion. But I think, names, we are positioned on the discretionary side rather than the staples side within the consumer buckets. We're liking themes like alcohol as in particular. We've been well positioned there.
Siddharth, just intrigued to know what made you take your positions out of the hotel and the hospitality space, because given the fact that, yes, of course, by the last month, towards the end, there was this Pahalgam attack that did happen, but the markets were on the roar indeed.
I know the markets were doing well, but no, so we follow a quantitative model. So when quantitative factors turn adverse, right, whether the value factor is turning adverse, the volatility factor is turning adverse, or other sectors of stocks are showing better strength. It's a combination or interaction of multiple factors which decide which are the top stocks to be held in a given market condition. So based on that, I think we moved out of hotels and airlines.
All right, Siddharth, thank you so much for taking the time out and joining us and weighing in on the markets. We will let you go on that note.
Thank you so much.
But moving on to an ET Now exclusive, the finance minister will